Welcome to the Deep Dive, where we cut through the noise and get straight to the most important insights. Today, we're diving deep into a recent earnings call that's, well, it's really a study in contrast.
Exactly. We're dissecting the second quarter 2025 earnings call. This was a period where the company achieved some undeniably significant financial milestones.
Right.
Yet the market's immediate reaction was noticeably reserved, maybe even skeptical.
Yeah, that's the interesting part. So our mission today is to unpack these results, peel back the layers of their underlying strategic shifts, and really try to understand why there's such a striking divergence between management's clear optimism and, the market's rather cool response. What does this all mean for you, the informed investor navigating these complex signals? Let's dive right into the top-level numbers first. So to kick us off, the second quarter of 2025 painted a pretty robust picture financially. The company delivered a GAAP EPS that's generally accepted accounting principles earnings per share of 0.05 cents.
Right, 5 cents.
Which was a significant beat, especially considering consensus estimates were actually predicting a loss, negative $0.03.
Yeah, quite a swing.
And their non-GAAP EPS also saw a substantial beat at 36 cents, far exceeding the $1.25 expectations.
Okay.
And revenue came in strong at approximately $257.3 million. That outperformed consensus and showed a remarkable 102% year-over-year growth. Pretty impressive top-line numbers, wouldn't you say?
Oh, absolutely. I mean, what's truly fascinating here isn't just that these numbers are strong. You've got triple-digit revenue growth. GAAP profitability achieved a full quarter earlier than planned.
Which is huge.
It is huge.
Yeah.
But despite these headline beats, the market's initial reaction was almost a shrug. It was quite reserved. And this immediate sentiment suggests investors are looking well beyond just the earnings per share. They seem to be grappling with some deeper questions about sustainability, strategy, maybe where the company is headed next.
Yeah.
It's kind of a classic case of good numbers, but what's the real story here?
That initial market skepticism is precisely what we need to unravel. So let's dig into those numbers further because the strength goes beyond just the revenue line.
Okay.
The company reported a contribution profit of $141 million. That's an 85% year-over-year increase, and they maintained a healthy 58% margin there.
Right. That's a strong margin.
And their adjusted EBITDA, that's earnings before interest, taxes, depreciation, and amortization, a key measure of operational profitability, it reached $53.1 million.
Wow.
Which is a dramatic turnaround from a negative $9.3 million just a year prior.
Big difference.
In fact, it marks the first time since Q2 2022 that the company has posted positive GAAP net income. We're talking about a return to real, actual profitability here.
Yeah, this isn't just a turn of the tide. It demonstrates significant operational leverage at play. I mean, think about it. They're scaling revenue much faster than their operating costs are growing.
Right.
And the sheer volume of loan originations tells a similar story. It surged by an astonishing 159% year over year to over 372,000 loans. And what really stands out to me is their impressive 23.9% conversion rate for those applications. But maybe the most telling detail, really a testament to their core tech advantage, is that 92% of these loans were fully automated.
92%.
Yeah. I mean, imagine the scalability implications of that. Fewer human touches mean faster processing, lower costs, and just the ability to handle massive volumes without proportional headcount growth. It's a huge competitive advantage. And management was very clear on the call. This growth wasn't simply a macro tailwind lifting all boats,
Right, not just the market.
No. They firmly believe it was fundamentally driven by their internal model advancements. The CEO specifically called out the launch of Model 22, highlighting its absolutely critical role in this quarter's performance.
Okay, Model 22, here's where it gets truly foundational for their business, I think. This model, launched in early May, represents a significant leap forward in their core underwriting tech. Their CTO elaborated on how it uses neural networks at every level of the model architecture, not just the base layer like they did before.
That's a key difference.
It is. And the result, it has increased their separation accuracy advantage over benchmark credit models by 17 percentage points. It now stands at a remarkable 171.2%.
Okay, so what does that mean in plain English?
Well, for you, the listener, this isn't just a technical achievement. It fundamentally means their AI is nearly twice as good at predicting repayment behavior as standard models.
Right. Better predictions.
which directly translates to significantly lower loan losses for them, and crucially, allows them to offer better pricing, particularly to their super prime customers. And they're constantly training it on, get this, over 91 million borrower repayment events.
Wow, 91 million.
Perpetually refining this model. That vast data set is what allows their model to achieve such, nuanced and predictive insights. It's constantly learning and improving their risk assessment.
And this innovation is clearly translating into new business lines, expanding their market reach, their newer products, particularly home equity and auto refinance.
Yeah, the secured stuff.
Exactly. They've collectively surpassed $300 million in quarterly volume already. And within that, small dollar loans and auto loans each crossed $100 million in Q2 originations.
Okay, so real volume there.
Real volume. And the strategic plan they outlined is to move the funding for these rapidly growing new products fully off balance sheet by year-end 2025.
Right. Get it off their books.
Which aims to ease capital intensity and significantly expand their bank partner capacity. It's a smart move, really, to transition from using their own capital to leveraging third-party funding for these emerging lines.
And they're not just talking about it. They're seeing real-world results, which is important. In their home equity business, they've launched instant property verification.
Instant verification.
Yeah, think about that. It allows the entire verification process to be completed in under 1 minute for some applicants.
Wow.
In a sector normally plagued by slow, manual processes, that kind of speed and efficiency seems almost, unprecedented. It dramatically speeds up loan approval.
Huge friction reduction.
Totally. And their auto retail product, which integrates their software directly at dealerships, is also gaining significant traction. Both dealership adoption and loan volumes are climbing steeply. So it's not just consumer loans, it's about integrating their tech into the points of sale themselves.
That makes sense.
Yeah.
Now, a key focus for management during the call was also the substantial strengthening of their funding supply. That's critical.
Right. Where's the money coming from?
Exactly. They expect to reach a new all-time high for monthly available funding in Q3 from banks and credit unions. They think they'll surpass their prior peak from early 2022.
Okay, so partners are stepping up.
Seems like it. Signals increasing confidence. They also successfully priced and closed their second ADS deal of 2025. That's an asset-backed securitization.
Right, packaging up the loans.
Yeah, essentially packaging loans into securities to sell to investors. What's important here is they achieved significantly improved execution and actually doubled the number of investors compared to their first deal this year.
Oh, interesting. More demand.
Indicating growing institutional demand for their assets, yeah.
But let's look at the balance sheet itself, because this is where some of that market skepticism might be coming from, right?
Mm-hmm.
Loans held directly by the company increased sequentially to about $1.02 billion.
Okay, that's noticeable.
It is. Management clarified this is a temporary bridging period for their new products. They said they need to sort of demonstrate credit performance and build volume with these newer offerings like home equity and auto refinance before they can fully secure third-party funding.
Right. Prove the model first.
Exactly. So they anticipate reversing this balance sheet expansion over the next couple of quarters as these products exit this incubation phase. So it's strategic to seed new products with their own capital, but it does weigh on free cash flow in the short term. No doubt about that.
And that's likely what the market keyed in on. On the competitive front, while the overall market is getting more competitive, especially with funding markets improving across the board.
Yeah, more players coming back.
Right. The company remains laser focused on offering the best value, particularly at the super prime level. This selective focus kind of insulates them somewhat from the more volatile subprime segments.
Smart.
They also highlighted that roughly 25% of their loans are funded by deposits from their bank and credit union partners. And what's interesting is that non-depository capital, like their ABS deals, is becoming increasingly competitive in price, effectively blurring the lines in the cost of capital for different types of lenders.
That blurring of lines and capital costs really highlights how dynamic this market is. But let's shift gears now, because beyond just their underwriting models, their CTO also detailed significant progress in servicing loans.
Okay. Managing existing loans.
Right. This isn't just about getting new loans. It's about how they manage the ones they have. Year over year, their population-adjusted delinquency rates are down 20%.
20%, wow.
And raw rates are down 32%. This is a huge win operationally. They're applying machine learning to personalize servicing actions and even predict individual recovery likelihoods.
Okay.
which directly improves loan loss rates and in turn allows them to price new loans more competitively or, more profitably. It's a virtuous cycle.
That makes perfect sense. And another fascinating aspect of their AI strategy is the generalization of their core technology.
Generalization? How so?
Well, for auto loans, for instance, they're now trading a foundational credit model on data from multiple credit categories across their entire platform and then fine-tuning it specifically for auto.
So learnings from personal loans could help the auto model.
Exactly. It allows all loan products to learn from repayment patterns across the whole ecosystem,
Yeah.
not just within their own silo. It means their AI models are getting smarter faster, benefiting from a richer, more diverse data set.
That's pretty powerful. And they're not shying away from generative AI either, are they?
Not at all. Internally, a striking 60% of their developers are already using LLM-powered tools.
60%.
Yeah, and teams have built over 700 custom GPTs for workflow automation. That's a massive internal efficiency play right there.
Huge.
But maybe more importantly, they've launched borrower-facing generative AI tools for model explainability and customer service.
Okay, helping borrowers understand.
Right, and they're even looking towards agentic management of consumer credit needs in the future, which essentially means AI could autonomously manage and optimize a borrower's financial decisions, almost like a personalized, proactive financial co-pilot.
Wow, that's a truly cutting-edge vision for consumer finance. Very forward-looking.
Definitely. So looking ahead, the company's macro assumptions remain pretty consistent. They're assuming a steady credit environment, stable interest rates, and a resilient labor market.
Okay, no major shocks expected.
That's their base case. For Q3 2025, they expect revenue of approximately $280 million and adjusted EBITDA of around $56 million.
Slight sequential growth guided.
Yeah. And for the full year 2025, they've raised their revenue guidance to approximately $1.055 billion.
Okay.
They're targeting a 20% adjusted EBITDA margin and positive free cash flow for the full year.
Okay, so that positive FCF target for the year is key.
It absolutely is. This guidance really underscores their confidence in hitting substantial profitability and, crucially, cash generation by year-end.
So we've covered the impressive results, the strategic AI moves. But let's circle back to the central puzzle here. Despite these strong results and the pretty upbeat guidance, the shares experienced a notable decline after hours. There was significant trading volume, a spike in put options. This divergence is, for me, the central puzzle piece we need to solve today.
Indeed. It's the critical disconnect. The buy side, representing large institutional investors, they noted a real profitability milestone, but rich valuation. That was the take.
Okay, valuation concerns.
Right. On the other hand, the sell side, typically analysts from investment banks, they acknowledged outsized beat yet lingering FCF drag.
Right, the free cash flow issue again.
Exactly. So this skepticism stems largely from that continued negative free cash flow. It was negative $113 million this quarter, as the growth in their loan receivables soaked up a lot of working capital.
Yeah, growth costs money up front.
It does. And you add to that the stock's truly significant run-up, what was it, 247%? Over the past 12 months?
Incredible run.
So you can see why some investors might be taking profits and questioning the funding mix and the capital intensity needed to fuel this kind of hypergrowth. It's a fundamental question. Can this growth model truly be capital light in the long run?
And this profit taking, it's happening even as the stock had rallied into the earnings print, right? It was riding a wave of rising AI fintech sentiment, some short covering.
Yeah.
It was previously boosted by their Model 22 preview and even a Fitch credit rating upgrade. So the market had definitely built up expectations.
Expectations were high.
And perhaps those expectations just got a bit ahead of the fundamental cash flow picture for some investors.
I think that's fair. Look, I think the company is strategically very well positioned, especially with its intentional pivot towards off-balance sheet funding and its focus on super prime customers.
Yeah, that focus helps.
That focus places it squarely ahead of more rate-sensitive subprime peers, especially if the credit environment tightens. Looking at key near-term catalysts, a big one is their September Investor Day.
Right. What are they expected to show there?
They're expected to detail Model 23 and, critically, the economics of their off-balance sheet strategy. That's what people want to see nailed down. The Q3 earnings print will also be crucial. They need to continue proving sustained profitability.
Show, don't just tell.
Exactly. Longer term, success really hinges on broadening their AI-powered credit franchise into secured assets like home equity, while also navigating these evolving AI model disclosure requirements. For investors, visible and consistent cash generation will be absolutely crucial for any further re-rating after this year's already impressive run.
So the skepticism isn't just valuation, it's that fundamental question about whether this hypergrowth can become capital light.
Right. But, for the discerning investor, this skepticism might actually be masking a strategic pivot that, if they pull it off, could unlock massive value precisely because the market isn't yet fully pricing it in.
Interesting angle. Okay, now for our This Is Not Financial Advice segment, where we pitch an outrageous but plausible trade idea based on today's deep dive. Your turn.
All right, here's my pitch. Given management's aggressive target to transition most new product funding off their balance sheet by year-end, and we just talked about the rapid adoption of instant property verification for ECLO tails, plus the new bank partnerships they've apparently already signed for secured products.
Okay.
I believe the market is severely underestimating the speed at which this company can truly de-risk its balance sheet.
Okay, that's a bold call. Betting on speed of execution. So you think they can pull that off-balance sheet transition forward faster than people think?
Precisely. My outrageous but plausible trade idea is this. A short duration, out-of-the-money call option spread targeting the Q3 earnings call.
Okay, Q3 call. What's the specific catalyst you're betting on?
The core bet is they announce a massive, ahead-of-schedule securitization or dedicated third-party funding arrangement for their current on-balance sheet home and auto loan portfolio.
So taking a big chunk of that $1 billion off their books sooner than expected.
Exactly. Something substantial enough to visibly alter the free cash flow trajectory and signal a clear path to capital efficiency. Such an announcement wouldn't just act as a powerful re-rating catalyst, driving institutional investors to maybe reevaluate their skepticism.
Right, forcing a rethink.
It would also cement the company's capital-light platform vision, potentially sparking a significant multiple expansion for the stock. It's basically a bet on execution risk being rapidly removed from the equation, surprising those who are currently just fixated on the short-term cash burn.
That is definitely outrageous, but plausible. A bet on surprising the market with faster de-risking. Okay, so to recap this deep dive then, we've seen a company delivering incredibly strong financial results.
Yep, numbers are strong.
Driven by what seems like truly cutting-edge AI innovation in both underwriting and servicing. And they're aggressively expanding into massive new markets like home and auto loans.
Well, the market showed immediate skepticism over valuation and that short-term free cash flow drag. The strategic path forward, particularly the pivot to off-balance sheet funding for new products and their relentless AI advancements, it presents a compelling narrative for the future. Understanding this divergence, this disconnect, and the key catalysts ahead is absolutely key for informed investors right now.
It's a complex, multi-layered picture, for sure, but that's what makes these deep dives so valuable, hopefully. We hope this exploration has given you a clearer, more nuanced understanding of the situation. Think about it. If their AI truly provides that much of an advantage in risk assessment, how much of a market share shift could we realistically see in these massive traditional lending categories down the road? It's a fascinating question to ponder, I think.
It really is. And just remember, the information discussed today is for informational purposes only and should not be considered financial advice. Always do your own research and consult with a qualified financial professional before making any investment decisions.
Absolutely. Thanks for joining us for this deep dive. We'll be back soon with another one.